Laura Wadding. I'm a partner with Deloitte, and I'm really happy to be here today at the Sustainability Summit. I have 25 years experience in financial services, and I specialise in risk and regulation within the financial sector. So over that time, as you can imagine, I've been at the forefront of the development and the adoption of different legislative reform frameworks around the financial sector for many years, including anti-money laundering legislation and UCITS and AIFMD and MiFID and GDPR. And it's safe to say at this stage that I've worn the T-shirt on a number of those. I lead Deloitte's sustainability market offering in Ireland. Very proud to do that, and it's something that I've taken on in the last year, and certainly keeping me busy in more recent months for sure. And I split my time between Dublin and Wexford in Ireland with my two daughters, and I've been working at home for the last 18 months. So I guess I would probably prefer to be in the office or out and about at least some of the time, but I've been really fortunate to be able to spend that time with my girls over the last year and a half, and I think that's definitely something I'm grateful for. Today, I'd like to share my thoughts with you on sustainable finance, and in particular, the role that I see regulation playing in achieving the desired outcome, whatever that desired outcome may be. We might chat through some of those concepts as well as we go. So I thought we might take a look at, firstly, what's meant by sustainable finance, because it doesn't mean the same thing to everybody, whilst there are some general principles there. So one definition would be that sustainable finance is anchored in a long-term ethical vision of financial investing, and that it seeks to reconcile economic performance with positive social and environmental impact by funding companies that actively contribute to sustainable development. So directing capital to those companies that are doing good from an environmental and social and governance perspective. Another definition would be that sustainable finance refers to any form of financial service integrating ESG criteria into the business of or investment decisions for the lasting benefit of both clients and society at large. So a bit of a spin on the first definition, but not too far removed. And then another definition would be that sustainable finance generally refers to the process of taking due account of ESG considerations when making investment decisions in the financial sector, leading to increased longer term investments into sustainable economic activities and projects. And so one thing that I'm struck by when I look through the different definitions of sustainable finance is that they don't quite all say the same thing. And one question that I would ask is whether sustainable finance is something that really only relates to the financial sector or whether it relates to all of us. And I think I would lean towards the latter. And hopefully we'll see why as we go through some of my thoughts around this. If we take a look at what's happening in the financial sector for a start, number of headlines. Honestly, there are dozens of headlines daily at this stage that refer to sustainability, climate change, ESG, and just goes to show the significant role that the financial sector is playing in all of this. So you've got our local banks, Bank of Ireland and AIB, launching products. So Bank of Ireland developing a nature-based funding instrument, AIB developing social bond framework. Then you've got non-financial entities producing financial products. So you've got Pfizer launching a $1 billion sustainability bond. Morgan Stanley announcing its commitment to reach net zero financed emissions by 2050. BlackRock making acquisitions in the market. The National Renewable Solutions company that they recently announced the acquisition of. And so you've got financial institutions playing really diverse roles across the sector. It's not simply about complying with regulation, but also about being seen to do the right thing, developing products that are sustainable, and also being seen in the market to do this. Now, with that comes risk. There's a reputational risk associated with all of this. And so one of the headlines that I couldn't overlook given my background in regulation is that, regulations could, and actually the reality is that regulations are and likely will continue to crack down on sustainable investment claims. And effectively what this means is that if you say that you're going to do something, or that you are doing something, you really need to follow through in that and develop a level of transparency in your reporting that gives investors, customers, and regulators comfort that that is actually what's happening. So you'll see a lot of headlines in the news about regulators investigating claims of sustainable investing or ESG investing, and I think that's likely to continue. There are a number of drivers, however, for sustainable finance and a number of differing points of view. Investor sentiment is obviously key, and some of the thought leadership out there would suggest that investors are actually the key to all of this. So they will choose where to put their money, and so they will drive this movement more than any other of the players in the sector. So I think that's a really interesting point of view, because the investor really is the one with the choice here. It's popular. It's certainly popular. It has been popular now for quite a while, and it's gaining in popularity. So, you know, I think by contrast to that, it's unpopular not to be on this journey towards sustainable finance. It's ethical. Certainly, the more we hear not just about the climate side of things, but the social and governance side of it, that, you know, firms don't necessarily want to have their investment strategies associated with organizations that don't have ethical practices in place and sustainable practices in place. So there's a link between sustainability and ethics for sure. And then we have the legislation, which we'll talk a bit about in a minute. But ultimately, and I think it comes down to this, you know, there is a climate crisis and money makes the world go round. And so there's no option to do nothing. And that's why finance and the financial sector has a really significant role to play in the climate crisis. And really, I suppose regulators, the policy that's being designed is there to redirect capital towards more sustainable investments. I mean, that is the goal ultimately, so that the sustainable activity thrives and the less sustainable activity or the damaging activity doesn't thrive by contrast. So that is ultimately the goal. But there is another view out there that regulators, policymakers, for instance, central banks, that they shouldn't mandate green investments. And I think it's an interesting point of view, and it really comes back to that question of choice. You know, so absolutely, I think it's incumbent on the financial sector, on the governments, on the policymakers to set policy around this and to provide transparency and to provide guidance. But can they actually take away choice? And I think that's going to be an interesting evolution with all of this. If I take a look at some of the regulation, I mean, we could go down a rabbit hole on this. There are at least 20 EU regulatory frameworks that relate to the financial sector that are going to be impacted by what's happening. But there really are three key ones. There are the Sustainable Finance Disclosure Regulations. So they apply to investment managers, investment product producers, investment advisors, and they are intended to cover the entire life cycle of an investment. And they also require investment products and their managers and advisors to disclose certain information about the ESG risks in the investment or in the investment portfolio. So they're quite important. It's almost like a starting point. The EU taxonomy, I say, it sits in the middle, and we'll see in a minute why I'm saying that, but it is intended to create a common understanding of the terminology, of the risks, of the you know, the different definitions and categories of climate risk in particular, and that taxonomy is going to be the basis upon which a lot of risk is measured and a lot of decisions are going to be made. So it's quite an important piece of legislation. And then we've got the Corporate Sustainable Reporting Directive. So the newest of the three, and it applies to listed entities and certain corporates over a certain size. And it is intended to require corporates to disclose certain information, which is in line with the EU taxonomy, so that the entities who are regulated under the Sustainable Finance Disclosure Regulations can make more informed investment decisions. So if that makes sense, and those disclosures will be required to be independently assured in time, I think by 23, by FY23 or 24. So there is connectivity between the different regulations, but they don't all have the same purpose. And you can see how one is intended to influence the other. And there are also other rules coming into play for banks that will require them to include climate risk in their financial models. And I think that's going to be quite technical and something that won't be that easy to implement, but nonetheless, it's coming down the tracks. This isn't, and I don't think I have made it sound very simple actually, but it really isn't. There are challenges with all of this. So there's a timing consideration. So you can have, so SFDR is racing ahead a bit of CSRD, and the EU taxonomy is sort of in the middle, and there's a risk there that when the investment manager is required to assess the ESG risk in one of the companies that it is invested in, but that company is not yet required to disclose certain information under the CSRD, then you come into an immediate timing issue that could actually influence firms' ability to do what they're supposed to do under the regulation. So that's something that's going to be quite challenging, and that's going to continue. So it is going to take quite some time for these regulations to embed in the risk frameworks and in the reporting frameworks of both corporates and financial institutions, and for everybody to be on the same page, if you like. There's a complexity to all of this. There's a complexity to the terminology. There's a complexity to what's in and what's out. And, we have lots of discussions with investment managers about the difference between an Article 8 fund and an Article 9 fund, and how do you get from one to the other, and made more complex if the fund itself is invested in complex securities, and so it's not an easy piece of regulation to implement. Now, I have been around, as I mentioned, for quite some time. We've seen MiFID and MiFID II coming into play. They're quite complex. That's quite complex regulation as well. GDPR is another one. All of the anti-money laundering regulation and all of the changes to that over the years that have applied really heavily in the financial sector. This is on par with those, if not slightly more complex, because some of the concepts are new. So, and I think it comes back to the first point there, that it's just going to take a bit of time for this to become a language and a way of doing things. And ultimately, I think that's the intention for sure. Another challenge really out there relates to the timing and the complexity, but it's the quality of the data that's available to assess the ESG risks of an investment or a financial product. And really this is something that the whole industry is grappling with at the moment, because unless an entity is required to disclose certain information, then the likelihood is that it won't, or it will disclose information but that won't have been independently assured, and so there may be a question around its reliability. Plus, there's a lot of data to be collected, to be analysed, to be able to give comfort to your investors that actually this is the risk, and in time perform an assessment as to whether that risk is within the risk appetite of the investor. And so there's a huge data element to this for sure, no less so than with financial services generally. I mean, data is very important to the sector, and so this carries that same level of importance, but some of the data is just not at the standard that it should be at right now, so that continues to evolve. And then we've got the question of the EU versus the rest of the world. So, within the financial sector, particularly within the international financial sector, we've got players based in Ireland, in the UK, in Central Europe, in the US, in Asia Pacific. There are financial institutions who are located all over the world, and they contribute to the economy in all of those countries. and they cross-invest in jurisdictions as well. So they move money between countries. And so the rules won't necessarily always be the same. They won't be the same necessarily between the EU and the UK, between the EU and the US and the UK. There's likely to be some divergence, and that's a normal part of policy making, where we don't have one single regulator around the world, and that's just the way it goes. So whilst governments are very supportive of the principles of sustainable finance, that doesn't necessarily mean that everybody will legislate and set policy in the same way. And so there may be some divergence, and that's always complex in an international financial arena and difficult to manage, particularly within one financial institution where you're trying to comply with absolutely everything. So I think that's definitely one to watch. And then at a more technical level, even within the legislation itself, within SFDR and CSRD, or SFDR probably more importantly, there are certain classes of instruments that are just not really well catered for. So derivatives will be one, and over-the-counter investments, unlisted companies. So those entities that are not required to report anything, it might not be that easy to actually assess the sustainability risk within those. And so then already, there's a challenge when it comes to reporting and making those disclosures to investors. And so I think without a doubt, whilst a really good effort has been made with regard to drafting legislation, level 1 and level 2, and so far, there's a lot of work that still needs to be done to get those right, for the sake of the transparency and the choice that is available to investors. So I might just wrap up with a few key takeaways on all of that. So without a doubt, the financial sector has a huge role to play. And the actions and decisions made by banks and investment managers and even insurers over the next few years in the context of climate change and sustainability and the social and governance aspects of that, it's likely that they will impact all sectors of society. So, if a bank is required to choose a more sustainable investment over a less sustainable one, then the entity in the sector that's less sustainable is likely to lose out. And we already see the emergence of financial products that favour sustainability. So the likelihood is that you'll get a better interest rate on your mortgage if you've got a higher efficiency energy rating on your home. There's funding available for solar panels and things like that. So you can already see that sustainability is favoured when looking for credit or capital or investment. So I think that's likely to continue. Transparency is key to facilitating informed choices. So, if you are a high net worth individual and you're looking at your investment portfolio and you're thinking, I really want to turn this into a greener portfolio, without the transparency, it's going to be difficult to make those decisions in an impactful way. So there's that direct impact, but also regulators just won't tolerate greenwashing. They've all come out and made statements about greenwashing and transparency and investor protection, and so that's absolutely key to getting this right. So sometimes first to the gate is not always best if it's not done right. So I think that's something that financial institutions have to consider really, really well with regard to not just being seen to be supporting this movement, but also to be doing it in the right way so that they can stand over the information, notwithstanding the challenges with the data that I mentioned earlier. One point to note is that there's an end goal here, and it's not simply to redirect capital to more sustainable economic activities. But what's the point in doing that? And I think that one of the reasons to do that is actually to improve what's happening with our climate and with our environment and global warming. So currently there's no real guarantee that this is going to work, and it's still about choice, and investors can choose not to. Once they have the information, they can choose not to make the greener investment. And so the big question is whether policymakers can actually mandate for this and insist that certain investments are no longer acceptable, and which is removing choice. So I think that's going to be an interesting area to watch. We are all in this together, whether we like it or not. We all live on the same planet, so there's no real room for vigilantes, and there's no room for ignorance. So we either all get this right or none of us get this right ultimately. And that's why I believe that collaboration is actually really key to this. So between public and private sector, between the banks and their customers, between investors and investees, we have to work on this together to get the right outcome. Regulation is not the only driver here. It is a big driver, and it's not perfect. So I think if we have more collaboration, the likelihood is that we'll strike a better note for everybody. And so that's probably the key message in all of this. And so that ends my my sharing of thoughts on the topic of sustainable finance. I'm happy to take questions during the event. We have a pop-up that you can visit by all means, and I'd be really delighted to hear from you. So thank you very much, and hope to speak to some of you throughout the event. Thank you.